A lot of TA helps identify trends and momentum, but these are the enemy of wheel traders. Too trendy of stocks, they often result in negative scalping, covered calls, or cash secured puts when you have to roll them later because the stock moved too much. That adds more time to complete a cycle. It is our goal to reduce the number of trades within each wheel cycle. That's the primary goal of using technical analysis for wheel traders. It's a big premise of what I talk about in the book.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 26, Lost in Home Depot. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. Help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. And if you're already a listener, you can support the show with a paid subscription. When you do, you'll get video extra podcast episodes so that you can get hands-on video training on things we talk about during the show, subscriber-only posts where I drill down on a stock or event or trading opportunity, and I share trade ideas. You'll get all my covered call and cash secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on some income trades like credit spreads and much, much more. And the best part is your paid subscription helps keep this show on the air. And it's been a while since I welcomed our newest paid subscribers. Welcome to our most recent paid subscribers, Matt, Bartek, Jesse, Shannon, Glenn, Ishan, Susan, and Yusuf. To join this list of wealth building paid subscribers, just go to wealthbuildingpodcast.com. That's wealthbuildingpodcast.com and choose a monthly or annual subscription. Or for the best value, become an all-in wealth builder and get everything I mentioned, plus our Friday group coaching, our Smart Income video masterclass, and get on the wait list to get a signed copy of my new upcoming book, Build Consistent Wealth with Options, which is scheduled for release on April 26th, 2026. Today, Wealth Builders, we talk about tools. Can you really even have enough tools? Seriously. I remember when Kathleen and I bought our first house, when our firstborn was still a bun in the oven. The house was a Chicago bungalow built in the 1920s. There was wallpaper on the ceiling in the kitchen. Hand to God. Yeah, I know. It was a 1960s flower pattern on it. It was awful. We also ripped up a corner of the carpet and found, oh, there's nice oak floors under there that we can finish. The whole place needed a paint job. We needed to get to work. We needed some tools. So we went to Home Depot, just like any other red-blooded American would do, and shopped around the store in all its glory. It was like Santa's workshop. We'd lose hours at a time wandering around the big box warehouse. And I wasn't really that handy back then, to tell you the truth, but still, I wanted the tools. I wanted the toys. After that trip, we made another, then another, then another. When our son was born and learned to talk, one of his first words was Dito. Yep, baby speak for Depot, Home Depot. He was there a lot with us. If the tool looked cool, I bought it. Then I figured out what to do with it. I still have a massive tool room of tools down in my basement. Anything that needs to be done, I got the tool for it. And that's the thing. There's one tool made specifically for a particular job. It just works better than other tools that weren't made for that purpose. As they say, the right tool for the right job, right? And that is exactly how trading works, especially technical analysis. Why are there hundreds of indicators and studies and things on the charts? Why? Well, because each one does one thing really well. A lot of indicators that a typical active option trader or even just stock or futures trader uses, well, a lot of those technical tools are for breakouts. But there are some excellent indicators that can help identify the waning momentum that contributes so well to skate objective wheel trades. One family of such tools are oscillators. Let's start out diving into them. And then I'll share a cool tool that I've been working on for months that's ideal for covered calls and cash secured puts alike. And hey, maybe we even get into volatility analysis this episode. Well, without further ado, onward. What is an oscillator? Well, oscillate means just goes back and forth, right? When I think of an oscillator, I think of, well, I think of a sprinkler, right? Those ones that go and then they go back and then they go back, just oscillate back and forth, back and forth. Apparently, there's also some sort of electrical thing that is an oscillator that controls something with electricity. I don't know. But the other context that I know the word oscillator is as a trading indicator. Because let's face it, a lot of stocks, I mean, they go back and forth, they go up and down. Sometimes you get the breakouts, but that's not what this is measuring. There are a number of different oscillators that are really, really popular. I'm going to read you a list of ones that you might have heard of. And if you haven't dug that far into technical analysis, once you do, well, you'll hear of them. One is the MACD, the moving average convergence and divergence indicator. The CCI, that's another one. Started out for commodities. That's one of the C's in there. Williams percent R. One of my favorites. I mean, the rest of this list are my favorites. I'm kind of saving the best for last here. But ADX, that's one I got a lot of use out of in my days. Also, slow stochastics. That is one of my favorites right there. And then finally, we end up with RSI, which is the relative strength index. Now, RSI, slow stochastics, ADX, especially when you use DMI with it, they kind of do similar things. They're not the same, but they do similar things. And so I've kind of settled a little bit more recently on RSI. Secondly, I'll look at slow stochastics, and then maybe sometimes I'll look at ADX these days. So let's spend the bulk of our time talking about the relative strength index, RSI. RSI is a momentum indicator that compares the size of up moves with the size of down moves of a stock's price over a period of time. That period of time, by default, the out of the box indicator is 14 days. the RSI when we pull it up underneath the chart. And so we should probably have a video extra on the relative strength index so you can see what I'm talking about. And I will record one of those for all of our paid subscribers. Many traders use RSI for momentum trading. It's kind of a pretty versatile tool, to tell you the truth. But wheel traders, we are not momentum traders, but overbought or oversold signals and divergences can indicate trend reversals, which can be very useful to wheel traders. Writing covered calls in uptrending markets, it's sort of like game fishing. You ever had any experience with game fishing? It's about more than just sitting in a boat and drinking beer. That's most of it. But you have to kind of know what you're doing. And I don't. I'm better at sitting in a boat and drinking beer, but you have to cast and, move the worm around a certain way, or the plastic worm. And then once you get them hooked, right, then you reel it in and then let out some slack. You have to kind of tire them out a little bit, then reel it again. But you can't just keep reeling because they'll be so strong, they'll break the line. So you reel it in, you let them out, reel it in, you let it out. It's a give and take. If you can get a sense of when a stock is overbought, that is, there's been too much buying pressure too fast, and the quantity that is bid, that is needed to push the price higher, has been exhausted, well, that's when it can signal a time with a greater chance of either skating on a covered call because the momentum's out of juice, or at least not seeing the stock burst too much higher through the covered call strike and violate the strike price. There are two key points on the RSI study. There's the 30-day line and the 70-day line. 30-day line is the lower one, 70 line is the higher one. And remember, it oscillates from 0 to 100, right? When a stock price has a lot of upward strength and the RSI rises above that 70 line, that's when chartists consider the stock to be overbought. Now, that said, a reversal in price doesn't necessarily happen as soon as it's overbought. I've seen RSI studies where it's in overbought territory for a long, long time. A reversal in price tends to be more likely to occur once the line crosses back down below the 70 line. So it goes up above the 70 line, and then once it comes back down the 70 line, that is where we tend to see the market reversal. During a strong uptrend, which again can often be a challenging time to write calls, the RSI crossing above and then back below the 70 line can increase the probability of a beneficial covered call trade. And that's why I use it. A mirror image sort of scenario exists for cash secured puts. When the RSI crosses below 30 and then crosses back above it, it can signal a reversal back upward for the stock price. That's a stronger time to sell cash secured puts, particularly for skate objective traders, assuming that you don't want to get assigned. That's a good time to sell cash secured puts because that's when probably implied volatility is still very high following that down move. But if it crosses back above the 30 line after crossing below it, that means that down move is starting to burn itself out, and you're literally putting something extra on your side. Do any of these indicators, studies, anything, do they predict the future? No. They enable us to get just one more little piece of edge, a statistical advantage. With indicators, there's also this thing called a divergence. A divergence is when, well, before I get into that, let me kind of help you visualize this. And the video extra is going to really help you visualize it because you're literally going to see it. But for all my listeners who are driving, riding their bike, running, whatever it is you're doing, I was just listening to a podcast on the rowing machine earlier today, which is kind of a challenge because they didn't have a decent pocket to put it in. It was kind of weird. But when you're looking at a stock chart, there's some indicators that are on the price chart, like moving averages and stuff. But things like RSI, they're typically displayed as what they call a lower indicator, and it's underneath it. So it's like the same dates that are corresponding to the stock price correspond to the RSI, right? It's just vertical on top of each other. On this day, the stock is this. On this day, the RSI is this. So a divergence is when the indicator shows something different from, so diverges from, what the chart shows at that time. Because remember, the whole point of an indicator is to more clearly understand what the data are showing. So when the highs or lows between a chart and an indicator diverge, we go with what the indicator says. So you might see something like on the stock chart, the stock is making higher highs, right? Which would be an indication of an uptrend. With uptrends, I talked about this on a show recently, we get higher highs and higher lows, right? Speaking of oscillating, higher highs and higher lows. So if the stock chart is showing, okay, a week ago it reached or 2 weeks ago it reached a new high, and now it reached a higher high than it was 2 weeks ago, well, that's a higher high. But if the indicator shows, okay, 2 weeks ago there was a high and then it dipped and then it kind of made a new high, but this high is not as high as the one 2 weeks ago, that's called a lower high. And when the stock chart shows a higher high and the indicator, RSI in this case, shows a lower high, that's a divergence. That is when you go with the indicator and it indicates that the uptrend is coming to an end, and that could be a good time to sell covered calls. Again, same idea with cash secured puts. You see a low in the stock chart followed by a lower low in the stock chart a little bit later. Well, that's this definition of a downtrend. But if we see on the RSI, it made a low, and then later it made a low, but it was a higher low than the last low, then that indicates that, hey, this downward move might be coming to an end, might be a decent time to sell cash secured puts. So those are two things that I, as a wheel trader, use the RSI for. I like to use it for crossing above and then below the 70 line, or below and then above the 30 line. And I like to look for divergences. To me, those are the two strongest cases for RSI. There's another indicator that I've been using. I actually created it, and I've been working on it on and off for months, and now it's pretty much right where I want it. So now I get to start using it a lot more aggressively. It's really, really fun. And I call it the PAS indicator. That stands for the price history anchored strike indicator. The PAS indicator is designed to basically cut through the guesswork of option strike selection. Instead of pulling levels out of thin air to set your strikes, which of course we don't do anyway, but it anchors each decision to a stock's actual historical price range over a defined look back period. We do this by grounding strikes in price history. The PAS gives traders a data-driven edge. And it's highlighting levels where probability, premium, and price action all intersect. Basically, what we do is we take the past range over a period of time that we correspond in trading days to the period, to the potential options expiration that we're considering using. Like if there's 10 days until expiration, we'll do a 10-day look back of the range in that period, put it into a moving average, and then we can go from there and we can set call strikes or put strikes. Now, I know that's a lot to think about. We'll definitely do something in the future, a show or something, maybe even a webinar or something, where we talk about that in great detail. But that's a little bit of a ways off. As a final note, wheel traders tend to use technical analysis differently from other traders, like I mentioned earlier. A lot of TA helps identify trends and momentum, but these are the enemy of wheel traders. Too trendy of stocks, they often result in negative scalping, covered calls, or cash secured puts when you have to roll them later because the stock moved too much. That adds more time to complete a cycle. It is our goal to reduce the number of trades within each wheel cycle. That's the primary goal of using technical analysis for wheel traders. It's a big premise of what I talk about in the book. So now let's shift gears to volatility analysis. And boy, oh boy, we're going to talk a whole bunch about this. We're just going to scratch the surface, I think, today, but let's get into it. This is sort of the third and final analysis in what I call the option traders trifecta. The option traders trifecta of analysis is fundamental, technical, and volatility analysis. Just as fundamental analysis may help us understand when a stock is cheap or expensive, volatility analysis helps us do the same with the option price itself. We're specifically talking about the volatility component of the option's value, isolating it from the influences of the price of the underlying moving, of time passing, or even of interest rates changing. Because the market directly affects the underlying price or interest rates for that matter. As a consequence of those direct market influences, option prices are in turn affected. Time is mechanical and predictable, right? We know if today's Tuesday, tomorrow's going to be Wednesday. If it's the 15th of the month, tomorrow's the 16th. The sun keeps rising every day. As a consequence of time passing, this predictable thing, option value decays. But implied volatility is a special metric. It's a primary driver. Implied volatility is the pure, isolated effect of supply and demand on option prices. And it must be understood in that exact context. Because sure, implied volatility, it's lent its name from the idea that traders think logically and make options buying and selling decisions based on their expectations for volatility in the future. And so that would imply that value must represent the market's collective expectation for future volatility, the volatility that is implied in option prices. But there's theory that's based on how a logical trader should think. And then there's how traders actually think. So I think I said this before. Implied volatility is always wrong. And that's hard for a lot of people to wrap their heads around, but it's true. An options implied volatility is always wrong. And it's usually too high. Sometimes it's too low, but it's usually too high, and it's always wrong to some degree. And that's mainly because it's humans that are trading options. Fear justifies overpaying for the insurance that options provide. And brashness allows for far too many traders, mostly retail traders, I would say, to enter the options market before really reaching a level of confidence, before really reaching a level of competence. There are a lot of traders who have uninformed buying and selling decisions, and that results in noise in the volatility market. And there's analysis myopia, traders who just want quick leverage and only focus on delta. And whether they overpay for the option or not is completely out of their mind's eye. They don't even see that part of whether the option's overpriced or underpriced. But then there's us, right? We're wheel traders. Those who are willing to put in just a little more effort than the typical trader. Yeah, that's what we're trying to do, isn't it? So what do? We analyze volatility. There are 3 steps to analyzing volatility if you want to figure out if options are overpriced or underpriced. We'll start out with, is today's implied volatility in the top or bottom half of the 6-month range on the volatility chart? And if implied volatility is in the top half of that range, that's an indication that options are overpriced. And then conversely, if today's implied volatility is in the bottom half of the 6-month range, that is one indication that maybe volatility and therefore options are underpriced. And the second thing is the implied volatility of the specific option being considered as a candidate for selling, is that implied volatility above or below today's historical volatility? Now, this is just another indication. It's not like the final deciding thing, but it's one of 3 things to look at. If the implied volatility in the option chain is above historical volatility, it's an indication that the option is overpriced. If the implied volatility of the option that we're considering selling in the option chain is below historical volatility, that is one indication that it is underpriced. And as I look at this might also be a good video extra also. Maybe I'll do 2 this week. I think I did 2 last time, didn't I? Anyway, the third one, is there an expected catalyst that has the potential to cause an outsized move in the stock before the option's expiration date? Because the big jumps in historical volatility that are caused by earnings announcements or Fed announcements or other expected volatility events, those are less than ideal when it comes to trading the wheel. If implied volatility rises, well, I mean, that's not really ideal either, because the option you sold has an element that makes it a little bit more expensive, all else held constant, like price and time. So that's not quite as important. And anyway, the option premium shrinks over time anyway. making a rise in implied volatility less of an impact. But a rise in historical volatility, meaning a big move in the underlying stock price, I mean, those are less than ideal. We've come this far in the show to know they're not deal breakers. They're not the end of the world. And in a lot of cases, it could be just fine. But we kind of just like to slow play these things and collect the theta and let everything just work out cool and copacetic. Those are the main tenets that we use volatility analysis for. And next time, friends, we're going to jump more into volatility analysis, especially in the context of selling those covered calls and cash secured puts that we all love to do. So that about wraps it up for this show. But before you go, please make sure you're subscribed on your favorite podcast platform, whether it's Spotify, Apple Podcasts, or whatever it may be. And if you would be so kind as to leave a comment, I would surely appreciate it. Let me know how we're doing. Let me know things you like about the show, or give ideas about the show that maybe we can work into future episodes. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.